people say we got to have those cuts. No, we don't. As long as the economy is chugging along at these rates, and it is, I follow the real data. There's no real reason to hurry up and cut these rates. And in fact, if you told me these rates are going to be cut a lot in March and let's say, April or May, I would worry the economy has slumped into a recession. So, this idea that we have to depend on, and no, if the rates are not cut, it means a stronger economy. The only bad situation, they're not cut if we have a flare-up of inflation. I do not see that.
Jeremy Siegel, emeritus professor of finance at the Wharton School at the University of Pennsylvania and author of the must-read book, Stocks for the Long Run, The Definitive Guide to Financial Market Returns and Long-Term Investment Strategies, which is now in its 6th edition. Professor Siegel, it is an absolute honor to welcome you to the show. Thank you so much for taking the time to join me today.
I'm happy to be with you and impart to you whatever knowledge I can about today's economy and the markets.
Well, I love it. Now, let me fill you in on where I always start with my guest, and that is their big picture macro overview and outlook. And I know you as a macroeconomist. So, Professor Siegel, I'd love to get the big picture take from you. And one of the things about this show, Professor Siegel, is you can take all the time you need to set the table, if you will. So let's start there with the macro view.
Yeah, and I think we should go back really to the pandemic to get the big foundation. We had an economy kind of chugging along really pretty well. We had a 2.5% inflation. We had pretty good growth. Everything was fine. The pandemic hit, and we then started an unprecedented fiscal expansion. There were 2 big programs under Trump and then 2 huge programs, multi-trillion-dollar programs under Biden. Now, the first program under Trump was bipartisan. 95% of Congress agreed we needed to spend. We needed to inject purchasing power into the system. I have no trouble with that. I have also no trouble with Chairman Powell of the Fed flooding the economy with liquidity. We just, didn't know how bad this could be, and we needed as much stimulus as possible. The second Trump stimulus was less necessary once we saw that we were getting things under control. And then the 2 Biden stimuluses were definitely not necessary. Now, we could have limited the damages of that had Chairman Powell reined in the growth of the money supply. But my background, my first teaching position, University of Chicago, I was, fortunate enough to be a colleague of Professor Milton Friedman, Nobel Prize winner. It was his last 4 years, actually, as a professor. My first 4 years, young assistant professor. I learned so much from him. He said, take a look at the money supply, M2 money supply. You won't get a close correlation year to year, but if you ever explode the money supply, you will have inflation. And 2020 saw the biggest single one-year increase in the money supply in 150 years. I then got on to the news programs and said, we're going to have a lot of inflation. It's going to come in a year and a half. This is not a temporary situation. This is going to produce inflation. And indeed it did. So I was very critical of the Fed. Then the Fed slammed on the brakes. And I, at first, thought it might be too hard. I wanted a more gradualist approach, but it turns out that after that excessive increase, slamming on the brakes was necessary. So at this juncture, things are looking better than they have for, in my opinion, 2 years. I think probability of soft landing is over 50-50. I do think their rate is certainly high enough, and honestly, they need to bring that rate down, and I'll explain why in a moment. However, I and everyone else, every other economist, including the Fed himself, is surprised that the high rates have not had a more depressing impact on the economy. Now, I attribute that to two situations. One, of course, is supply side renormalization, but also inflationary expectations never got ingrained in the system. We had the inflation, but in contrast to the 1970s, where inflation got ingrained and people predicted it was going to be 6, 8, 10% a year for 5, 10 years, we never had that. So we can bring, once inflationary expectations does not get ingrained, you can bring down inflation much easier without causing a recession.
That was a fantastic frame up for this conversation, and a couple of threads I want to pull on with you, Professor Siegel. And one was that you just brought up that you think the rate is high enough and that we need to bring that rate down. And I would love to hear the explanation. You mentioned that you have an explanation for that. Can we explore that further?
Yeah, certainly. There's a couple things that I think are reasonable, 2 or 3 reasons why we have to bring the rate down. First of all, we have an inverted term structure. Now, we know that over the last 60 years has been an extremely reliable indicator of recession, although because of the unusual circumstances of the pandemic, you can't count on it. But why tempt fate, if you want to use those words? Short rates are normally below long rates. And as we know, the 10-year is around 4, and we have Fed funds at 5.33. So we're really quite inverted. Secondly, inflation is coming down, no question. So the same rate means keeping Fed funds constant would mean that the real rate of interest, which is the nominal rate, which is Fed funds minus the expected rate of inflation, is going to be going up. In other words, we're going to get tighter in rates if we don't bring rates down. And a third reason is that we have to get the money supply, liquidity, growing again at 5 to 5.5% a year. That is a money supply rate that is consistent with the Fed's goal of 2.5% inflation and 2% real growth of the economy. We have had basically no money growth over the last year. It stalled out. In fact, it declined from basically April 2022 until early 2023, stagnated. We've had a little bit of increase in deposits last couple of weeks, but it's too early to tell. We've got to get bank lending back onto that course that is sustainable. So I think there's 3 reasons why I want to see that rates lowered. The real rate, the increase in liquidity consistent with normal growth, and bring a normal term structure curve with long rates higher than short rates back to the economy.
So part of that, to get the banks lending again, you would need lowered rates to get them that money supply going again. Is that right?
Yes, that's correct. Because basically, money is created. The Fed creates currency outstanding and the amount of currency directly, but the main part of money is deposits at banks, and that depends on lending. And you can encourage lending by lowering rates. People are not taking out home equity loans and not taking out other forms because the interest rate is just so high. Certainly that has helped in bringing the inflation down, but you don't want to overplay your hand. And, my feeling is that right now the price level has risen to use up that extra money. And if we don't start bringing money back up again, we are going to squeeze liquidity to the point where we really threaten the current expansion of the economy.
Hey there, I hope that you are enjoying this interview. If you can, please take a moment to hit the like button, subscribe to the channel, and ring the notification bell. This will keep you up to date with all of our new interviews, and it will also help us grow this channel and continue to bring some amazing guests. Thank you so much for your support, and enjoy the rest of the interview. Okay, so just let me ask a bit more on this as well, because you're mentioning you aren't seeing people get mortgages right now and things like that. How about the commercial real estate side of things? I feel like that came up. Yeah, we just had bank earnings, a lot of them on Friday. Certainly, it seems to be like there's a bit of a grim outlook there. How do you think about that side of things, or maybe just banks broadly, if you want to go there as well?
Well, certainly, I mean, the pandemic has totally changed the commercial market. There's definitely write-downs on mostly small, medium-sized banks. They're very tiny percentages of the big banks' portfolios. I think there's going to be mergers. There's banks are going to be owning some property that they don't want to own, but they're going to be owning it. And then prices, the small banks are going to take a hit. But I think that mostly is in the economy now. I know there's some people that say, oh, it's a time bomb, that people are sticking their heads in the sand and they don't see it. And eventually, the banks are going to be in trouble by owning it. I don't think so. I think people know that there's a lot of B-grade buildings and lower that are just not going to be sustainable. However, also, commercial real estate is only one aspect of real estate. The office space, particular. I'm thinking. I mean, other parts of real estate are doing very well. I mean, certainly home building. I mean, home building is being restricted by the mortgages, but home demand is very strong. The equity position of businesses and American homeowners is never been higher. So it isn't like what we saw, a 50% drop in home prices from 2007 to 2009 during the financial crisis. We see none of that whatsoever. So we don't have an impairment of liquidity. In fact, stocks and bonds are hitting new highs in terms of the factors. So yes, small and mid-sized banks, they've taken a hit. They're already down 30-40%. I think that's pretty appropriate. They're going to take some losses. Many have already. But I don't think that is going to be a time bomb that is going to sink the economy in the next couple years.
Mm-hmm. Let me ask you about your outlook for the Fed and expectations there. I imagine, do you expect cuts? When would we likely see the cuts? Do you just have more of an outlook as it relates to the Fed?
Yeah, and by the way, I got my PhD in economics actually, and then I went into finance and economics. But monetary theory and policy was my specialty, and I followed the Fed very, very closely. Here's my prediction: the Fed will not raise this year. No reason that I can see. It's a question of how fast will they lower. Let me also say that there's a big misunderstanding among many in the financial media, and even if you want to know the truth, when I read financial reports from people who I think should know better, they use the Fed funds futures markets as an unbiased estimate of what investors think the Fed funds will be in the future. I've studied that market. That's not an unbiased market. And the reason is that there are risk considerations in those futures. Many investors want to own Fed funds futures because if there's a real crisis, another pandemic, a geopolitical crisis, a financial crisis, the Fed will lower rates. And stocks will go down, but your Fed funds will go up because don't forget, they're based on if Fed funds interest rates go down, Fed funds prices go up. And in other words, to use a phrase, they are counter-cyclical assets, they are hedge assets, they are insurance assets. Now, what does this all mean? It means that what we see in the market are downward biased estimates of what the rates are. My estimate, for instance, 1 year out, and people often talk about what's going to happen by the end of 2024, that it's between 1 and 1.5 cuts, and I'm talking about 25 basis point cuts, downward bias. So as a result, people say the market thinks there's going to be 6 cuts. I really look at it as 4 to maybe 4.5 cuts is really what's in the market. Now, I know the dot plot in the December meeting showed 3 cuts. So it isn't as far off as a lot of people say in terms of what the actual market is relative to what the FOMC is projecting. Secondly, people say we got to have those cuts. No, we don't. As long as the economy is chugging along at these rates, and it is, I follow the real data. There's no real reason to hurry up and cut these rates. And in fact, if you told me these rates are going to be cut a lot in March and let's say, April or May, I would worry the economy has slumped into a recession. So, this idea that we have to depend on, and no, if the rates are not cut, it means a stronger economy. The only bad situation, they're not cut if we have a flare-up of inflation. I do not see that. Now, we do know that, there are events in the Middle East that, could, cause some jump in the oil market, but I do not. First of all, we are much more insulated against it than we were, certainly were in the 1970s. We are basically self-sufficient in oil. I don't see it having a big impact on the economy. We got through the Russian invasion of Ukraine. When was it? 2 years ago, and the oil spiked to 100. So what I'm saying is that I don't see anything out there, commodity-wise price or anything else, that will cause a spike. So as a result of that, I don't see inflation coming back. And as a result, if you told me, gee, the Fed funds rates are going to be brought down slowly, I would not change my outlook for stock prices as a result.
So real quick though, what you mentioned that many folks think that we need 6 cuts to have a good 2024, and I apologize if I missed it. Why do you think so many people have that view? And it sounds like that's a misguided view.
Yeah, well, there's several reasons. First of all, you'll need more than 6 cuts to uninvert the term structure. Just about. I guess we're at 5.33 on Fed funds. We're 4. So we're 5 to 6 cuts would bring Fed funds down to 4. And that flattens the curve. If we want to go down to 3.5, which I think is a long-term Fed funds rate going a couple years into the future, that would mean an 8 cuts approximately from the current. So if you want to uninvert the yield curve, you need about 8 cuts. People also know inflation's coming down. They don't want the real rate to get any higher. We don't. What consumer is spending, but it has run out of a lot of the extra liquidity that the Fed produced from 2020 to 2022. And again, if you don't bring rates down to create more loans and liquidity, you risk squeezing the consumer and having a cutback in consumption. We all talk about the fact that it is the consumer that's keeping the economy strong, and it is true because really capital investment has not been that strong. Home building has suffered because of the high rates, so we need the consumer. If he or she gets pinched as a result of using up all the liquidity and finds that they don't want to borrow at these current rates, you could really have a turn down in consumer spending. Now that is the reason why I definitely support a drop in these rates. But I monitor the consumer. He and she have been amazing. They've been amazing. They've kept it. I didn't think they would keep it at these high rates. Everyone, including the Fed, is surprised. And I keep on monitoring it. And if as long as they continue to spend, then my feeling is you go slow on lowering them. But be alert. The Fed must be two-sided. If it sees signs of weakening, then it must react very quickly on the rate side.
When you say must be two-sided, what does that mean exactly?
Two-sided in the sense of the following. I interpret last December's FOMC meeting as the Fed recognizing that there are downside risks to the economy that now match any inflationary risks on the upside. The biggest worry for the markets was that Jay Powell was going to be as stubborn on the downside as he was on the upside. He waited way too long, as we know, and if he was going to wait too long on the downside, if we saw weakness, we would have a recession. I think what he signaled in December was, I'm aware of downsides. And that's what I mean by being two-sided. He's now seeing risk on the downside, which encourages people to say if he sees weakness, he will lower rates. And that is, in my opinion, the major reason why we had that tremendous rally at the end of 2023 was not so much that, there were going to be a lot of cuts, but that he was going to cut if necessary. And I think a lot of people misinterpret it as saying we have to have those cuts rather than he will cut if necessary. That was the most important, in my opinion, message of the December FOMC meeting.
Yeah, I have to say, I'm really enjoying just listening to you, Professor Siegel, and learning from you, and a few more follow-ons to this too, because going back to the top of the conversation, when you were talking about the economy, and you put a note out recently with Wisdom Tree, is it fair to describe the current state of the economy as a bit of like Goldilocks environment? And you mentioned like it's 50-50 soft landing. Is the other side of that 50 or the other side of that coin like the downside, like a recession or a hard landing? Can I hear more on the economic picture?
And actually, I recently think it's 60-40 soft landing, which means no recession. And if we have a recession, a very mild one going forward. The Goldilocks situation is no one anticipated, including the Fed, 2023 to be as good as it is. And when I mean as good as it is, that the Fed was anticipating less than 1% real growth in last year. We're going to have over 2%. They anticipated unemployment rising to between 4.5% and 5%, and we're still well under 4%. They anticipated inflation falling, and it has. So they're smiling. They have a smile on their face. They may have had an egg on their face two years ago by being really not acting anywhere near as soon as they should have. But clearly, it's worked out much better than they thought, than I thought, and by the way, than any other private forecaster has thought. Or public forecaster. What difference was? I did say at the very beginning of 2023 that despite the problems facing the economy, I thought we would have 10 to 15% S&P. I was one of the very few people with a positive S&P projection, and even I underestimated how well the economy, stocks did in last year. We all missed it on economic growth. I hit it pretty well on what happened to the stock market. I thought the Fed would be forced last year to lower rates in the case of weakness, but we didn't see that weakness. It was in July, I switched and said, hey, this is a different economy than I thought. And I began to say the Fed might be right in staying as high. Don't go any higher or much higher. I said, if you go to 6, you will have a recession. I'm glad they stopped at 5.25.
If you go too high, okay. So you were one of the few, 10 to 15% on the S&P. Not many people were even expecting any sort of positive returns for the market. What do you think went right for your thesis, or what do you think you got right?
Well, what I had was I thought the stock market was pretty well priced for a recession, and I said I'm not sure it's going to happen. So in a way, and it didn't. I said I think there's more possibility of upside. If we do have a recession, it was going to be flat. But if we don't have a recession, as we didn't, then I could see a 15 to 20. So I kind of tempered it a little bit and kind of took in the middle there. So in contrast to others who are predicting a big drop in earnings, Wilson from Morgan Stanley and a number of others. I did not see anything like that. I thought that basically it was priced for a recession. We were already in an earnings recession. We had already had, remember, in 2022, we already had 2 quarters of negative GDP growth. So I didn't see a lot of downside. I didn't see as much upside in the GDP as we got. However, let me say one other thing that I did anticipate. In 2022, we had the worst productivity growth, I think it's 75 years. I said it was going to bounce back, and it did. I mean, one of the reasons we had such good GDP growth last year was not that we hired more people. We actually hired less people than in 2023 than 2022, but their productivity went up. We had unprecedented drop in productivity in 2022. We recovered that in 2023. And by the way, I would not be surprised to see that productivity continue to gain in 2024.
I can't remember exactly where I heard it, but do you have a different take on productivity or how we should think about productivity?
Well, productivity is, output per person hour worked. It has been slowly slowing down over the last 20 years. It took a little jump during the pandemic because a lot of people weren't working, but the processes of producing kept on going on. But then it sort of collapsed after that. And I think in 2022, we had terrible productivity growth because of a couple things. I think work at home, people weren't used to it. Also, I think, if you want to know the truth, I think a lot of people thought they couldn't be fired. There was a labor shortage. A lot of people, there was remember the term quiet quitting?
Mm-hmm. Oh, yeah.
Yeah. I mean, like, oh, yeah, all right, I'll do what I want to do. Try to fire me. You can't find anyone else. I think that disappeared last year because firms did release that the labor market is nowhere near as tight now as it was a year and a half ago. So I think a lot of people have said, listen, I better buckle down, whether I work from home or at the office. If I don't produce, I may not have a job. So productivity is coming back. I actually am very positive on productivity. I think AI, artificial intelligence, may also boost productivity in 2024 and beyond. So I think the productivity recovery that we saw in 2023 is likely to continue in 2024.
Got it. Okay, so what is your outlook on the stock market this year? I know last year you had 10 to 15%. What is the market outlook for you? How much might we expect in terms of
a little more subdued, 8 to 10%.
Mm-hmm.
And also we should mention the following. And when we talk about, I saw 10 to 15, and we had I guess between 15 and 20 or whatever on the S&P. Remember, it was a 2-stage market. I mean, we had growth stocks doing fantastically, and value stocks really being lethargic. It was an exact mirror image of what we saw in 2022, where the growth stocks collapsed and value stocks did well. In fact, over those 2 years, all S&P value growth, Russell value, Russell growth, all the segments were basically zero. Small stocks did not do well, but among large stocks, value and growth and S&P were zero over 2 years. But boy, did they have a roller coaster ride, falling, growth stocks collapsing in 2022, recovering completely in 2023, value stocks doing really well in 2023, and then doing 2022, and then lethargic performance in 2023. So it really there were really two markets. Now, why do I say that? Because I think this is going to be a year where value will outperform the growth. I think the Magnificent Seven will not do as well as the regular S&P this year in 2024. This is not a certain call because these great companies, these big companies are very special, and I certainly wouldn't say get rid of them, but they have very high price earnings ratios, high expectations of growth. And if there's competition and growth does not come out as well in those sectors, they will not do as well. The other stocks, the value stocks, 13, 14, 15 PEs, you don't have to have much growth to get a good return. It's almost like your surprise is much more to the upside. Only a recession would hurt those stocks. So looking at the scenarios that I look at 2024, I see a regaining of value stocks outperformance over the growth stocks this year.
Does that mean do we get back to one of those more like active management stock picking a la kind of Peter Lynch market environments, or are you more of like in the indexing camp?
I'm an indexer. I've never been really very good on individual stocks. I've been much better on thinking about the market and broad themes of what is going on. So, some people say this could be a stock pickers. I think that's sometimes advertisement for the active stock pickers. It's always easy to say that. Especially if you think it's going to be a flat market. Oh, I'm gonna get you those that are going to do better. That you always want to outperform no matter what, whether it's a down market or an up market. And there's very few people, as we know, that have consistently been able to outperform a wide-based index, and that is why I've been an indexer with tilts, one direction, other value or growth or whatever, but basically a broad-based indexer, really from the very beginning.
I have another question too, just about. I was reading your book, but I can't remember the number now. Stocks in the long run, what's been the average return? Is it 8%? Or where?
So
okay,
over 220 years, over 100 years, over 50 years, the average after inflation rate of return on stock, dividends plus capital gains after inflation, has been 6.8% a year. In other words, between 6 and 7% after inflation. And what's important, Julia, to note is that, when I look back 220 years, the first 120 years of it, we had basically no inflation, and all the inflation been since World War II, and yet the real returns on stocks have been the same after as before. Stocks are great long-term hedges against inflation. If you worry about inflation, don't worry about owning stocks as a long-term portfolio. You will do very, very well in those circumstances.
Mm-hmm. So we've talked about stocks. What about the bond market and your outlook there?
Well, here again, I think I expect short rates to go down this year. I don't expect much movement in long. People say, what do you think at the end of the year the 10-year will be at? I say about 4%. That's where it is today. I don't think we're ever going to get back to those 2% bonds or 1% bonds or I think there was one point we had 57 basis points on the 10-year bond. Crazy. We're not getting back there. I mean, inflation reared its ugly head. Bondholders are whipped in inflation. They won't forget that. You're investing 10 years, 20, 30 years out. You got to worry there may be another episode like this in your future. You got to protect yourself by demanding a higher return. That's why I think we're back to the 4% norm on the long rate, and 3 to 3.5 eventually on the short-term rate.
Okay, and then going back to stocks, I want to bring this up too, because this was in the book, and you coined the term the noisy market hypothesis. I'd love for you to define that. And is that kind of characteristic of the environment that we've been in terms of the markets? Are we still kind of in that? I would love to just hear that.
Yeah,
hypothesis.
Right. I've written some articles. We talk about efficient markets where the price is at the rational point every single moment of every day. I don't believe that. I think that there are all sorts of shocks to individual stock prices. Some are higher than they should be. Some are lower. It's hard to know. But one reason I like the tilt towards the lower PE markets is you're generally going to get a higher number of those stocks that have had negative shocks to them and are undervalued in that sense. Now, I know that value stocks have underperformed growth stocks over the last 10 years, so that hypothesis has not held. But when we look over 100 years and over longer periods of time, those who have bought more reasonably priced stocks have in the end outperformed those who have bought the higher priced stock. So I like that tilt. And that tilt is rationalized by this noisy market hypothesis. The fact that it's hard, that some stocks are just bumped upward for reasons, others are bumped downward. And I might not know which are which, but if I take those that are lower priced relative to their fundamentals, earnings, dividends, revenues, I will catch a higher number of those. And in the long run, I will outperform on a risk-return basis than I would if I just bought the market as a whole. Listen, I'm not criticizing straight indexing. It's done really well, and I'm still advocating indexing, but I advocate indexing with a value tilt to it, even though that has been a difficult trade over the last 10 years.
Yeah. Well, I have to say, I'm learning so much from you, Professor Siegel. I want to learn a little bit more about you because I understand you have been a professor for 49 years, 45 of those at Wharton, and 10,000 students who've gone through your classrooms and lecture halls, which is just so incredible to think about the impact there. But how did you become an economist or a professor? Like, what's your story? How did you get into this?
Well, I always knew I wanted to be a teacher. I loved explaining things to people. I did tutoring when I was young in science and math, which I was very good at. I was always fascinated with the stock market, although I thought I was going to be a math teacher before I took my first econ course in college. And I loved it so much, I knew I was just going to be in economics, teaching somewhere. I was very blessed. I got my PhD at MIT in economics. My first job was at the University of Chicago. I taught there 4 years, and then I got a great offer from Wharton. I came to Philadelphia there, and I loved it here and spent the rest of my career here at Wharton. I love teaching. As I said, almost 10,000 students through that nearly half century of time. I had very big classes because I was very popular, but I loved it. And I've been blessed with having such good students, being at good universities, rubbing shoulders with great researchers, and having such good support that I've had.
Okay. I heard something about you that I want to bring up because I just thought it was such a really fun fact. You were on a podcast years ago with Barry Ritholtz, who I just think is wonderful. And you revealed to Professor Siegel, that you had actually never taken a finance class yet. You are an incredible finance professor. You're legendary. You wrote the kind of definitive book for finance. That's just incredible to me.
It is quite an unusual circumstance. I'm self-learned in finance. I actually, my undergraduate was Columbia in New York City, and I graduated with an econ and a math major. And then I went into the economics department at MIT for my PhD. One has to realize finance was just getting developed. I mean, Markowitz's theories, Sharpe's theories were in their early stages. If I were born 10 years later, I would have probably been a finance PhD. But at that time, people told me, "Oh, you take econ, learn macro," and I was very fortunate. Who was in my class at MIT?
I know. I'm going to say Robert Schiller because
Right.
you are lifelong friends.
Lifelong friend Robert Schiller and Bob Merton, another Nobel Prize winner.
From was that the Black-Scholes model?
Yes.
Was he part of it?
He was the one that helped with the Black-Scholes. He didn't get his name on that model, but he was considered it. Both Bob Schiller and Bob Merton were in my class. 135 people in my PhD class, the entering class of 1967.
Wait, how many people? 5?
There were 35. 35. Okay, but it wasn't a huge class.
That's still legendary.
Wow, we had some really shining stars, but I kept on taking monetary policy. I just never took the finance class. I just really I talked with my friend Bob Schiller and Bob Merton, and we talked a lot of issues, and we kind of figured it out on my own. So I'm sort of self-learned in that area, which is really kind of remarkable. But it shows you I'm very fortunate. I have a very macro background, which I think is really important to understanding the broad-based movements of asset prices such as stocks and bonds.
Mm-hmm. I love that because I was going to ask you, I was like, how important is the macro side of things? It sounds like that's incredibly important.
Very important. I think one of the things that people like about stocks for the long run, it's written from a macro perspective, a real long-term economy perspective. There's a lot about it, the performance of the market, but it also puts it into the context of what is happening in the real economy. And I think that helps ground people and understand how you get returns from assets such as stocks.
Let me ask you, in your career and all of the places you've worked and studied, who's been incredibly influential to you in your career?
Oh, I would say by far the most important person is Milton Friedman, because I talked to him so much when I was the 4 years at Chicago. I admired him very much. I had read a lot of his books before I went there. I shared very much of the libertarian philosophy of Milton Friedman, but mostly his economics. And I love the monetary policy. I love the monetary history of the United States, for which he got the Nobel Prize, cited that. I mean, it really changed my view about how you look at the Fed, monetary theory, and policy. I also had an absolutely wonderful PhD dissertation committee at MIT, Robert Solow, who just passed away, by the way, I think at age 98. He was my head thesis advisor, and the other two were Paul Samuelson and Franco Modigliani. By the way, all three of them eventually won the Nobel Prize in economics. So how could I do better than that? Their guidance was really important. So great students at MIT, great professors, and Milton Friedman at Chicago, and just a great support group all the way around.
I love that. Well, I have to say, Professor Siegel, it has been such an honor and just pleasure listening to you and learning from you. I want to give you a few minutes here at the end. Let folks know where they can, find you, your work. I know you put out a column with Wisdom Tree. If there's anything else that you would like to plug, and also, any parting thoughts, anything that you would like the audience to think about, maybe something that we didn't bring up in this conversation, please take the next few minutes to do so.
Right. And as you mentioned, I'm a chief economist for Wisdom Tree. I have a podcast that shows that actually it's live Sirius on Sirius XM, channel 132 at noon every Friday, but that's turned into a podcast, and it is written up. If you go to the Wisdom Tree website, you can sign up for the commentary that comes out early the following week on that. So that's how you can keep up. Of course, I'm on CNBC and other news media very frequently, and I'm very happy to share my views on that. I think the major message, and I think it's inherent as in stocks for the long run, that stocks are the most volatile asset class in the short run, and all the drama is it up and down, bear market, bull market, but it is the most stable asset class in the long run. Its real return of between 6 and 7% per year has persisted for more than 2 centuries. No other asset class shows the stability over long-term periods of the return as the stock market does. So don't get frightened when there's a downdraft. Don't get frightened in a bear market, especially for your younger viewers and listeners. You stay with it. In fact, it's always been an opportunity to buy more stocks, not less stocks, when the market goes down.
Well, Professor Jeremy Siegel, thank you so much for being so generous with your time, your knowledge, all of your wisdom. Really appreciate you taking the time today. Thank you, Professor Siegel.
Thank you, Julia.